Hi, I'm Jimmy. In this video, we're looking at Apple stock, ticker symbol AAPL. This video is part of our Dow 30 series, where we're analyzing all 30 stocks in the Dow Jones Industrial Average to try to see which stocks are a good buy at this point, even though the stock market overall seems to be overpriced. I'll leave a link in the description below to all the companies we've already done. Okay, so we're going to look quickly at Apple's business, and then we're going to see if we can come up with a fair value for Apple's stock, and I'll tell you where I might consider buying it. And in the name of full disclosure, I actually own one share of Apple, but I'll touch more on this a little bit later. Okay, so let's jump right into Apple's business. So we could break Apple's business into two primary segments. This is according to their 2020 revenue, according to the most recent annual report. They have their products and their services. Products accounted for about 80% of revenue, services the remaining 20%. Now, in their annual report, Apple goes one step further and breaks down their products, the products that they sell, according to the revenue. We can see that the iPhone is the largest revenue generator, at least it was in 2020. And then they have wearables and accessories, and finally Mac and iPad round out the rest of the numbers. Okay, simple enough. Now, with this in the back of our mind, let's take a peek at Apple's revenue going back the past few years. And clearly we can see that overall the trend has been higher. But there are clearly some years where Apple's revenue jumps more than other years. And each of these increases are at least partially due to the fact that there was an increase in revenue from the iPhone. In 2015, just as one example, revenue for the iPhone jumped by about 50%. That was from about $100 billion in revenue to about $150 billion. In that year, the whole company generated $230 billion, so clearly the iPhone is an enormous piece of that pie. And then in 2018, there was another big jump in iPhone sales. During that year, it jumped about 20%. Now, during 2018, there were also jumps in both wearables and services revenue. So it's not just the iPhone, but the iPhone is a big part of overall revenue. And then 2021, that year's not yet complete for Apple. Their fiscal year ends in September of each year. So clearly they're off to a pretty good start. They're showing very good numbers this year. And that is, again, largely because the iPhone sales have seen two great quarters, particularly the past two quarters have been very good year-over-year changes. So the past 12 months are showing a big jump, which should prove useful for 2021 in general. Okay, so clearly revenue is doing well. How about profit? So when we switch over to Apple's earnings per share over the past few years, this chart looks very similar to the way revenue looked. The trend is again positive, with a few individual jumps, once again, for the iPhone sales that we already talked about. And one of the ways that Apple's able to, the revenue and profit charts are able to look so similar is because Apple's profit margins are consistently in the 20+% range. You're talking low to mid 20s, which is quite good compared to most companies. Just as an example, I looked up the average net profit margins for the S&P 500 companies, and it's slightly under 10%. So Apple's more than double that, which again is quite good. Okay, now let's shift over to coming up with a fair value for Apple's stock. And what we're doing is we're using discounted free cash flow, and basically we take estimates going out the next few years for free cash flow. I got those from different analyst reports we're able to find. And when we do the math, we get a fair value of about $114 per share. But that's not accounting for Apple's debt and cash. Now, real quick, if you're not sure how to do this type of calculation, I actually did a whole video where I run through how to come up with each line item, where to find the information, how to project the information if we can't find analyst reports. So I have an Excel template and everything. So if you're curious, I'll leave a link to that DCF guide in the description below. But basically, what we do is we take expectations for free cash flow and we discount that by our discount rate. In our case, we're using a required rate of return of 7.5%. We then grow it out by our perpetual growth rate. In this case, we're using 2.5%. And just like that, we end up with a fair value of $114 per share. But most companies, you should account for both their debt and cash. They generally call that net cash, or net debt, actually, net debt. It's debt minus cash. In Apple's case, they have about $120 billion in debt, but they have $200 or so billion in cash and cash equivalents. So in theory, that excess cash should mean that the company is worth more. In this case, it's about $5 per share more, bringing the fair value of the stock to about $119 per share. And just to see how that stacks up to the current price, this is Apple's stock chart over the past year. And we can see that it's about $130 per share as of the recording of this video. So 119 is not too far away from the current level. And like I mentioned at the start of the video, I actually own 1 share of Apple. And I've been looking for what could be a good price to buy more shares. I'd love to own more shares. And frankly, I'd love for this stock to drop below the 119 level before I would consider buying it. And then on top of that, I think it's smart for us to add a margin of safety to our purchase. And basically, what a margin of safety is we can look at it as sort of a cushion below our calculation of fair value. And many times, the more confident that we are in our research, the more confident we are that our calculation of fair value is the right one, well, the lower the margin of safety could be. And I've talked about, in some previous videos that I've done, talked about some of the companies that I'd like to buy. One example is a company that I also own, which is Disney. And I said I need a very small margin of safety there. In that case, I set my margin of safety as 5% below our calculated fair value. For this one, I'd want a little bit more. Now, in a previous video where I talked about the number of companies that are in my, I call it the bullpen, companies that I'd like to buy if they get to the right price. Well, I have Apple on that list, and I actually had their margin of safety at 10%. Now, when I first started this research, I was considering, do we drop their margin of safety down to 5%? But frankly, after doing the research, I don't think it's smart for us to lower our margin of safety because there are some concerns I have with their business. And here's what I mean. When we go back to this pie chart here of Apple's segments, well, we look at these iPhone sales, and iPhone sales are dominating their overall revenue. We saw the same thing when we looked at their revenue chart. And once again, we know that this is driving their profit chart, which means that if iPhone sales were ever weak, we saw individual years, look at this profit chart. There are years that profit drops, and we know that that is largely due to weaker iPhone sales. So in an industry like technology, where a company must continue to innovate every year, if they ever put out a dud of a phone, that's going to hurt their revenue, and it is likely to hurt their stock price. The other thing it would hurt when we switch back to our discounted cash flow calculations is suddenly these projections for free cash flow are now in question. And if those numbers got lowered, well, our calculation of fair value would drop, which is why we add a margin of safety to that. So in my mind, I think it makes sense to keep the margin of safety for Apple stock at about 10%. I think that's a very reasonable margin of safety for such a solid company with some potential risk out there. Now, I'm not too nervous in the short term about this potential risk because, just as one example, Apple recently had their Worldwide Developers Conference, WWDC, Worldwide Developers Conference, and it seems that they had a few announcements. They were updating some software changes. They were announcing some software changes and some new products that they were talking about pushing out, and those products seem to be well received. So again, this is a good sign for their business, at least in the near future. But this does not change their current exposure to needing the iPhone to do very well. So again, that's why I think it makes sense to leave a reasonable margin of safety. I call it 10%, which means we want Apple stock to fall in the low 100 range before I would consider buying more. Now, if you're curious why I only own 1 share of Apple or the other stocks that are in my personal investment portfolio, well, I actually did a video where I go through my investment portfolio and explain how and why I bought each of them and how I ended up with Apple shares or Apple share. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I've got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.